from CNBC's parent company, Versant. This is the first time we've released these results publicly as an independent entity.
Baby.
Earnings coming in at $1.99 per share. No, we're gonna give it to you straight.
A lot of that is you. A lot of that is you.
Thank you. Hold on. Let's just give everyone the straight story here. Revenue of $1.69 billion, beating estimates of $1.62 billion. Now, linear distribution revenue was down 7.3%. We're going to walk through each of these pieces here. Advertising revenue down 5.2%. All of this, by the way, both expected and actually better than what the analysts had expected. Platform revenue, and this is really where the growth opportunity appears to be, rising by 9.5%. Platform revenue includes things like Fandango. I don't think that people always appreciate that Versant owns businesses like Fandango. This is also the golf app and other things that you probably use. Company announced a $100 million accelerated share repurchase agreement. And I think the most interesting piece of this whole thing, I don't know how much you've now looked into these numbers, but on a standalone adjusted EBITDA basis, and there's a lot of confusion in these numbers in particular because there were different estimates that had been made when the company was part of Comcast and everything else, you would look at it and you would say it was a positive 4.8% up situation.
Right.
I think that's a much better situation, frankly, than the investor community had been giving this company credit for. You know, I think a lot of people look at cable companies, and there it is, up 7%. A lot of people have looked at these cable companies and said, "Oh, goodness gracious, these are declining assets." And it is true that the cable portion of these businesses is complicated, no question. And you're seeing some of those numbers come down. But on the other side, between platforms and other pieces of it, A, I don't think it's coming down nearly as fast as some people think, and B, I think some of those other numbers are rising faster.
Their declines can decelerate or stabilize.
Yes, they can.
For the first time in our career, they're breaking out like ratings for CNBC and for MS Now, which were CNBC's ratings were up 15%, best, or not 15, up double digits.
Right.
But the best.
Which, by the way, also had a big impact on advertising.
Which you said down 7, I think. I think it was down. It had been dropping 10 or 12 in previous.
Well, you would look at the linear distribution is down 7.3%, and that's the unbundling of cable, and that's the piece of it that people knew. By the way, that's not out of league with what's happened more broadly. The better piece is that advertising has actually held up, I think, better than people thought. You had content licensing, by the way, up 113%. The platform business, as I said, up about 9.5%.
MS Now had the best year, these were the best numbers in a couple of years, I think, as well, in terms of the ratings for MS. The idea is all this cash flow that we've been generating, and I do mean we, for years, is no longer going to subsidize Peacock or subsidize whatever.
Right, and that's going
NBC.
Back to
it's going to go back.
The acceleration in terms of buybacks.
Someone like Barry Diller took a QVC or whatever that was, and it was like, why is he buying that? And look what it became. So you get a talented, smart management team in to do things, and who knows what could happen.
That stock up now, by the way, up 11% right now.
Came at 47.
Yep.
Went to 27. Mm-hmm. And I think there was obviously, who knows what that selling was. A lot of people, people that own Comcast may have wanted not to own Versant or whatever, but now, so 27 approximately was the low, now back to almost 45.